Like, well, where did you start with all this? Because I feel like this is not, you don't. It's not a direct career path that people
Right.
even know about, right? This is like that higher end stuff. Like people don't know how things exist,
Yeah.
you know.
Yeah. Yeah, well, it's funny. If I were to really trace it all the way back to my roots, at one point in my career, I was actually a high school science teacher, which
Okay,
a lot of people don't know.
nice.
But I'll spare you those details. But well, I think it resonates with a lot of folks. I was tired of being broke. I wanted to do
Hmm.
more with myself, and the first step out of that was to go and get a business job. And I had gotten myself a contract finance role, even though I was a high school science teacher, and just you know I guess you could say I was a little bit lucky, but I discovered myself and my strengths. I did really well in the corporate world early on.
Hmm.
Ended up getting into a big consulting firm, Accenture. If you've ever heard of it, they're a global firm, and they typically will hire Ivy Leaguers.
Hmm.
And I got lucky enough to get in. They sent me back to business school, so that's where I got the business
Oh,
education
nice.
and started implanting me in big companies all over the U.S. with global operations and working on, um, really intensive and complex business issues. And so really from there, and I'm kind of leading in because it's kind of been a squiggly journey, right?
Hmm.
Around the time of the Great Recession, and I wouldn't say this was strategic. I'd love to say I was this smart then, but I really said, hey, I'm going to jump into real estate. And like most folks, I got started, by buying courses, throwing the credit card down, just trying to
Hmm.
figure it out. But it was a necessary evil. I think folks who just try to learn it all on their own end up losing a lot of money or never do anything.
Yeah.
But um, I stepped into a few programs, learned a little bit, and I combined that with the business knowledge that I was gaining to start to build teams. I started partnering with universities to feed me college interns, so I had free labor.
Ooh,
Um,
smart.
yep. And
Yeah.
they basically were my call center and my marketing team. And I started getting off market leads for folks who needed to sell their home or wanted to sell their home. And I figured out how to raise capital. And before you know it, I was flipping houses here in Connecticut. So that's really where I got started in real estate, was single family home flipping at a time that was very good for
Hmm.
that.
Yeah.
Um, and, I was at a point where I was traveling a lot. And Mondays I'd get up and I'd get on a plane and go to like Richmond or Detroit or some other part of the country, and I would work there all week. And one day I was sitting in my hotel room thinking, I'm here for a week. Why don't I just build a team here and start flipping
Hmm.
houses here? And so I leveraged my job to start building teams in different markets around the U.S. And before I knew it, I was just replicating my model, partnering with the universities, community colleges, whatever, getting an agent, getting some contractors, and then I was flipping houses in multiple markets. And, that was really good to me
Hmm.
for probably 5-ish years,
Yep.
from 2010 through 2015.
Hmm.
But, then it became a different market.
Yeah.
That it was just different. I think really a couple of things happened. There were fewer houses to buy.
Hmm.
That was sort of that period where all these gurus popped up on social media that
Hmm.
started to become a thing, teaching everyone how to get into real estate. And what you found was exactly that. Everybody's diving in, and you have these bidding wars on what few houses were left. And it was driving up prices, and so it was compressing margins on deals. There was a lot of a risk inherent in flipping houses. I'm sure we could
Yeah.
probably trade some stories there. And what I quickly learned over time, and I didn't have the benefit of working with fine home contracting, Dave, but I realized I hated babysitting contractors all the
Mm.
time, and I was burning out, and my career was growing. And I said, I don't like this. I don't want to do this anymore. This isn't why I got into real estate. This isn't passive income. And so I just let the business run itself out. I actually gave some of my employees to some of my competitors here in Connecticut,
Nice.
and I took a year off, and I was like, no, I'm burnt out. I'm good.
Yep.
Um, but I got the itch again, and I came back, and that's when the multifamily journey really started for me.
Yeah,
That
gotcha.
was that was a long story, but
No, no, that's awesome. I mean, it's interesting because in that 2010 range, there were so many foreclosures that it was a flipping dream because
yeah,
there's just so many, distress. They didn't, the bank didn't winterize it, burst
yeah,
pipes, and
you
so
saw a
it's
lot of that.
ineligible for, and no one wants to touch that other than a flipper. Um, and that's where we started getting into renovation loans, where the banks would kind of create flippers they would fund for someone to buy the house, and then we would fix it. But it's interesting following, the demand. As a
Yeah.
business, as an entrepreneur, you want to follow what's the big demand right now.
Yep.
So you come back. I mean, that's a big jump though from residential homes to like figuring out the big,
So it wasn't, we weren't doing large scale multifamily yet. So I should clarify. So I came back and I started buying, your 4s and your 5s, your
Okay.
6s.
Yeah.
I didn't like anything less than 4.
Mhm.
But I built a sizable portfolio around, Northern Connecticut. I leveraged some of my connections across the U.S. To do some joint venture deals in some different markets.
Yep.
But really, I was buying, small commercial, large residential multifamily for probably, 4 to 5 years.
Yep.
COVID hit. Everybody kind of paused to see what was going to happen. And in the moment of pausing, right, prices just went through the roof.
It's crazy.
And I thought, oh shit. Well, I benefited nicely from the properties that I did own, right? It was like I went from millionaire to multimillionaire almost overnight.
Yep.
But that's really what drove me into the commercial space. I said, all right, the economics just isn't working on the small stuff anymore. I've got enough small multifamily. Let me try out this syndication thing.
Yep.
And so, happy to get into the details, but built a new team, a new brand. Ultimately, after studying mounds of data, decided we were going to go target the Midwest. And then to your point, we leapt right into 50 plus towards 100 units at a time.
Yeah.
Apartment complexes in the Midwest.
And that's a different, that kind of stuff. How do you find that stuff? Because those kind of buildings they're not on LoopNet most of the time, right?
No,
you kind of really have to.
Yeah, you'll hear, it's a lot different than the small game where people say, oh, you want to do your deals off market, they're better. And they tend to be. You can push for your own terms. But in the commercial space, you really don't see a lot of that. I mean, it happens, but it's extremely rare. The bulk of the deals are all transacted through brokers. And so we don't really waste any dollars, or we don't burn any calories trying to get off market deals on our own. But we work primarily with brokers. And, our strategy initially, and, it was sort of by design. I'd like to think that it worked out according to plan. Maybe it was purely coincidence, but I said to my team, we can try to cast a wide net like most people and just start calling brokers all over the U.S. and markets that we like and underwrite everything and eventually land something. Or we could pick one market. We could get to know every broker in that market who touches and sells commercial real estate. And we'll start pulling deals. This is the LoopNet tie-in. We'll start pulling all the deals off of LoopNet initially, underwrite the heck out of them. We know they're crap deals. We know we don't want them. It's sort of a wasted time, but it's an investment of time. And I think it really sent the message intentionally, and I think it worked. We wanted to show them, hey, one, by interacting with us, we know what we're talking about, and two, we're serious about buying here. And so, you go through a couple of deals that really are a waste of time. You work on that for a few weeks, and then eventually somebody says, all right, here's a deal, right, that they would save for one of the other mouths that they're trying to feed on a regular basis, the types of deals that really do transact off market, the stuff you hear about and you think, is that really true, because you don't see it? So that investment of time really opened that door for us, and that's when, we started to get those assets that you really want to buy, that have the real value add opportunity.
Right.
And that's how we got started.
So and you're going across. I feel like so you're do you feel that there's, because of the size units that you're at, that there's only so many deals in each state, and is that kind of why you're?
Yeah. So the product is definitely limited, but there are far more multifamily out there still, I think, than people might realize. But definitely, and depending on your strategy, I mean, if you're only targeting 150, 250 plus, then those complexes are extremely rare. They're in the more developed markets. Right. You're, down in like Jacksonville, for example, newer markets where that type of product is being built. You go to a market like Cincinnati, which has its nooks and crannies that are really good. Cincinnati as a whole is an older city, and back then they didn't build them very big, and the vintages on the property are typically very old. So syndicators who say, oh, I want 200 units and I only want to buy something that's 1985 or 2000 and newer, if they want to go to Cincinnati, there's just nothing there. So I think it depends on your strategy. Largely driven by your strategy, and then that of course you have to align it to the market that can fill your mouth and feed the stomach, so to speak. But definitely less product. In the Midwest, you see a lot in like
Yeah.
the 20 to 50 unit range. And we were okay with that initially, especially because we were just getting started out. And so we tailored our strategy to that. And we picked up a couple of assets. It's funny because I feel like we did a couple of deals that were 56 units, 56 units, 58 units, 44 units. They're all kind of like, it's like the magic number out there.
Yeah. And is that's all strictly residential apartments?
Yeah.
Or
Yeah.
I would
So,
imagine some of it's mixed use too, though,
no, we
no?
don't do any mixed use.
Okay.
All traditional multifamily.
Okay.
Yep.
Nice. Okay. So that's kind of, because when I think of, Connecticut, there's a few towns that even have stuff like that,
Right,
So
yeah.
I would say it makes sense that it would limit, how many, and if they're not wanting to sell, then
Yeah. Yeah, exactly.
it limits it,
Yeah, you're more likely to find 4, 6, 8 units here. Yeah.
Yeah. Torrington and Waterbury is kind of,
Yeah.
So I think it's interesting because that jump in any entrepreneur is a mindset jump.
Yeah.
So where do you feel, where was that kind of, was it and not to get too much into the, personal help side of things, but it really is. I mean, when you go from, I'm not fiddling around with this small stuff anymore, let's go big.
Yeah.
Was there a point in your life where it was just kind of, was it a book, or was it was it something that just made you say, let's go for it?
No, and I guess that's a little bit what baffles me because I've been asked this question many times.
Mhm.
I think I'm the apple that fell far from the tree. I grew up in a small farm town, didn't know any entrepreneurs, didn't know anybody with money.
Yep.
I just would always kind of get an idea and say, who has the knowledge that I don't have?
Mhm.
Who needs to be looking over my shoulder before I make a decision or step on a landmine? And that was kind of always my approach, surround myself with people who know the things that I don't. So that was for me really just the moment, when I decided the deals weren't working out, I wasn't going to get the returns I wanted. I wasn't going to get the returns my investors wanted.
Mhm.
Because even when I was buying a 4 unit, even if I could buy it in cash myself, I always like to raise money to
Right.
stay liquid for other investments. But, once I realized the deal wasn't going to work for them anymore, really the decision for me wasn't so much the mindset shift. I knew I had to build a different team. It's a different animal.
Mhm.
Um, this might sound funny. Maybe it was a little bit more of a moment of greed because I knew in the syndication space, there's more players at the table.
Mhm.
You're dividing up the equity more. And I thought, and I knew some people in the space who would say, oh, I own 600 units. And I would say, well, the 20 units I own in Enfield alone, I make more in a year than you do
Right.
as a limited partner of 600. So
Yeah.
it took a while for me to get over that, but it really is a game of scale. So I think the real mindset shift for me was, and I said this to my team, if we're going to do this together, the day we start, we have to commit to going to 2,000 units.
Mhm.
Otherwise, at some point, we're going to stop and say, geez, we're killing ourselves and we're doing good, but we're not doing great. And this
Mhm.
isn't worth it yet. And so we've got to have that strong vision, stay committed to it and just get there.
Mhm.
Otherwise, yeah, you're not really going to make what you
Right.
want to make.
Right.
Or at least, yeah.
And the bigger numbers are probably more. You got to be able to stomach it. You got to be able to deal with the stress at that level too.
Yeah.
And then how do I feel like everybody? It's interesting because the skill set to raise money is a big. That's where a lot of success is.
Yeah.
And everybody thinks that there's no money out there, or they go to their local bank and the bank says no, and I think that's the typical. But the reality is there's so much money out there.
Yeah.
There's so much money that is just and it wants to be worked.
Yeah.
It wants to work.
Yep.
And people don't realize what do you feel is how do you go about that? What do you think is the reason why you've been able to, because is it, you think you're, the sales side of thing or just?
Yeah. Well, I think for me, I think for me, my strength has been in really understanding the power of what real estate can do for them,
Mhm.
being able to dilute that into a story that they can understand because it feels complex and to a degree it is, but right, it's like anything. If you can dilute it to like an 8th grade reading level when you're
Right.
speaking to somebody, then they really understand it. And I think, you know, articulating your story and showing them how you're just like them and how you've made it work, and
Mm-hmm.
all that stuff is really important. It just builds that kind of
Right.
personal trust and credibility. And then, I was always in the beginning, especially, I was good at distracting them from the fact that I was brand new by really qualifying the team and not just myself, and
Mm-hmm.
saying, here's all the risks that are inherent with this deal. And so here's the team that I built, and here's our plan for managing against that. And so when you can show them that there's a real plan here, you've acknowledged the risks, you know exactly how you're going to
Right.
monitor it to see if it's getting out of control. Um, you know, the raising the money at that point actually becomes pretty easy. It's really just in how you tell the story, and I guess I'm lucky that I'm good at it.
Yeah.
And like you said, there's so much money on the sidelines, and I think a lot of times folks are too assuming about who has it and who doesn't.
Mm-hmm.
There's inheritances. There's
Yeah.
just money everywhere.
Yeah.
I'll joke. I literally have one of my earliest investors was a bus driver, a woman who very low income from a salary perspective, driving a bus, but had a very large inheritance. And had I not been openly talking at a local community event about what I was doing and the opportunities that others had to partner with me, she never would have raised her hand and said, oh, I'm interested in that.
Right.
I've got this inheritance. So I think a part of it is folks just have to get comfortable talking about what they do all the time and
Mm-hmm.
being able to tell
Yeah.
that story in a moment's notice.
That is a cool story though, because who would have known? And I think everybody has a similar story where you have no idea who these people are from or whether their family is. But again, kind of going back to that jump, it probably also working through the imposter syndrome of like
Yeah.
when you step into that first big room and you're just like, wow, I was
Yeah.
how did that feel, and how do you think you process that?
Yeah, that's a big one.
Mm-hmm.
Imposter syndrome I think is something that we all struggle with. That
Mm-hmm.
never really goes away entirely because you're always trying to level up to the next thing,
Yeah,
right? And
yeah.
so it's always kind of there with you. But for me, I like to. I guess the analogy I'll give is kind of like muscle memory for an athlete. You
Mm-hmm.
know, um, a lot of. I was actually just the other day watching this thing about Tiger Woods, and he was talking about this magnificent putt he made once in the Masters, and he was saying he doesn't remember. It's like he blacked out, right? It's just rote repetition for him, muscle
Mm-hmm.
memory for him. He had done it so many times that his body just kind of took over. And so for me, it might sound funny to some people, but I would literally, because I was a traveling consultant, I'd be in my hotel room at night or in my car driving. I'd be talking out loud or in the mirror as if an investor was asking me questions. And you always kind of imagine you're sitting down with somebody and you're telling this very linear story.
Mm-hmm.
You're starting with your beginning, you're talking about the deal and the market. You have this vision for how it's all going to go,
Mm-hmm.
right? Is the
Yeah.
point, but it never really goes that way. So I think preparation is key. The degree to which you can be prepared to insert yourself anywhere in that conversation just allows you to just kind of fall into that
Yeah.
phase of muscle memory. So for me, I was so practiced and rehearsed that in a way it allowed me to really kind of forget that I was even anxious and that I was brand new because I already had the answer. I
Mm-hmm.
mean, that was really my tactic.
Yeah. That's good. I mean, you hear that a lot in sports where, you know, they're actually they're kind of manifesting. They're going through and playing it all out in their mind,
Right.
right to their every single step, and then right to the point where they're holding the trophy, and so you're thinking about how you're winning, um, and I think it's interesting. You're absolutely right. You never lose that kind of am I supposed to be here? But what I like in any opportunity is if I'm scared but I'm also excited, then I'm doing the right thing.
Yeah.
You need that kind of that little like balance.
Absolutely.
If you don't have that, if you don't have that scared feeling, you're not pushing yourself hard
That's
enough,
right.
you know. Um, so really interesting stuff. I mean, obviously, I follow you on social media, um, and you're inspiring. You're running and stuff. I'm like, geez, Kris, come on, you're making us look bad. But how what is your you're really that primarily what you do for exercise is running and
Yeah. Well, I run 4 or 5 days a week. I go to the gym every single day,
nice,
and
yeah,
I get up at 3:45 in the morning
mm-hmm.
because later in the day something always comes up, or
Yeah,
maybe you're just mentally defeated. But nothing could ever get in the way at 4 in
mm-hmm.
the morning except for you, right? So every day I'm up, I work out. It gets gets the day going. And in a way, it makes you feel like you could do anything because, you're doing something nobody
Yeah.
else is doing.
Yeah.
Yeah. So,
It's kind of like that. I forget who says, make your bed in the morning. It starts that,
yeah, a
that
small win.
accomplishment, that small win. Yeah, I think, health is key to deal with stress too.
Yeah.
Having, my wife and I do a lot of like, sauna and cold plunge. We have a cold plunge at the house,
Oh,
and
nice.
it's like, I need to exercise more, but at least that cuts my stress. It just, you can it kind of gives you that reset to be able to think about, some of the issues. But walk me through your what does a deal look like? Like, what is your, okay, you want to go on your next deal. What's your, I don't think people even understand how this starts. So
Yeah.
so so you were going to go to another state right now.
Yeah.
You're like, listen, I think I've got them. There's no deals here that I know of, and it kind of makes sense. Like to get a lot of market share takes way more time than to going to the next territory and hitting that top half.
Yeah.
You know what I'm saying? So, what would you're going into a new area. What's your steps?
Yeah. Well, first you want to understand the opportunity and the risk, right?
Mm-hmm.
You want to get a sense for the type of product. Is it there? For example, if assisted living is your thing, then you're
Mm-hmm.
probably going to be looking for markets in Florida where you've got the boomer population. The overwhelming majority are near the age or at the age of needing some form of assisted living. Just a real generic example, right?
Yeah.
But for us, multifamily, generic multifamily, um, you know, really Arizona, Florida, Texas, right? They've all been stealing the headlines for 3, 4 years now for very good reason. Lots of growth. Everybody's moving there.
Mm-hmm.
Lots of dollars, obviously, then following that in terms of investment, infrastructure development. And so everybody's investing there. For me, I look at more than just population growth. You know who the rookies are because if you say what makes a really good market, they'll say population growth,
Mm-hmm.
and then they'll stare at you and expecting you to smile, and that's just one part of the equation. And I'll tell you a story, and I think it kind of ties in the answer, hopefully. But 3 years ago, 2 years ago, when I decided to go to Indiana, I had a lot of people tell me, and investors included, call me when you have something in Dallas. And I said, beware about Dallas. And they would say, why? I would say, well, look, you're seeing all kinds of record parabolic population growth, all these dollars flooding into the market, right? But there's a whole lot of supply coming right behind it.
Mm-hmm.
And now, fast forward, and I told them, I said, listen, you've really got to look at these pro formas that you're getting behind. So like the business plan that these other operators are sharing with you and saying, put 100,000 into my deal because we're going to increase rents 10% year over year. And these are all the things that we're going to do to make sure this property goes from 20 million to 40 million in value. I said, you really have to understand the pressures that new supply is going to put on that.
Mm-hmm.
Right? You get tens of thousands of new units coming online. Now these tenants are looking at units that are as nicer, more amenities for the same price. Where do you think they're going to go? Or potentially even cheaper, where do you think they're going to go? And so now you've got a situation where there's so much competition for the same tenant, you can't achieve any more rent growth,
Mm-hmm.
right? Aside from the fact that inflation's biting the wallet as it is, you've got this competition. So when you can't achieve rent growth, already your business plan's going underwater.
Mm-hmm.
Already your investors aren't getting any returns. They're potentially going to lose their money. And so, I can go on and on about all the bad things that, I projected that were going to happen are actually happening.
Mm-hmm.
Actually, I have a lot of investors who have now called me and said, Kris, you're right. I want to invest. And they've now since invested with us in Indiana. But, I look for markets where affordability is actually extremely low,
Mm-hmm.
right? Texas is extremely expensive. Why would I look at affordability? Well, first of all, Indiana as state as a whole is just about the most affordable state in the entire United States.
Mm-hmm.
It's kind of, Ohio's probably, maybe you can argue is first, but it's a close second. Fort Wayne, Indiana in particular has been cited as the most affordable place to live in the United States. Guess where we invest?
Mm-hmm.
Fort Wayne, Indiana has education programs, 200-degree programs from 3 of the top universities in the country with campuses in that market. They have steady growth of population, and wage growth is on par with the rest of the United States. So when your cost of living is lower than everywhere else, but your wage growth is on par with everywhere else, where are you going to go establish your roots, especially if you're coming out of one of these big universities? Point is, it's ripe for stability and future growth. And I
Yep.
knew that. I saw that in the data. I said, we're going to go invest in Fort Wayne, Indiana. Fastest growing market in the Northern Great Lakes region that nobody seems to know about because they're only looking at the shiny objects. And so our deals have done extremely well. And we're continuing to scale very quickly now because of that. But, I tell you all that because that gives you, I think, a little bit of a sense for how I choose the markets that I'm going into. I look for, when you're going in and you're putting millions of dollars down, it's a little bit different than putting 100,000 into a 4-family, right? So,
Right.
we look at wage growth, job growth. That's obviously important, but we look at supply and affordability. We look at, the strength of the employers in those areas. I'll give you a really good example. We just did a 56-unit deal in Evansville, Indiana. Where the hell is Evansville, Indiana? I had an investor say to me, Kris, I don't know if I can invest there because if I'm telling the guys at the yacht club and they have to pull out a map to figure out where it is, he's like, I don't want to do it.
Yeah.
And so I eventually invested with us, but I didn't really know of it either. And when you have these sort of tertiary markets, the types of employers in the area become extremely important because they tend to be smaller. They have smaller balance sheets. The point is they can't weather economic volatility. They're more likely to shutter their doors. And then you see that those dominoes fall across those local markets and landlords included. And so, but when I started to look at the companies that are employing people there, you can pull their, their public companies. So you can pull their 10K statements. You can look at their investor relations reports, which most investors don't even know how to do. I do because of the nature of my day job. You find they are headquartered in Europe. They have operations in 40 plus countries. They have global demand for their products. They make non-durable goods. Our economy is typically skewed towards durable goods. So think like, furniture, a refrigerator, et cetera. All the things people are in a hurry to go out and buy when the economy is really good. But during a recession, they start to say, I don't really need that right now, right? And so that's why you see manufacturing dependent markets like in Ohio tend to feel that pain at a much greater magnitude. Evansville, Indiana makes plastics, chemicals, and things that are used in other products around the world. They make chemical fertilizers that are used by pretty much all the farms in the United States. Point is, they make products that are recession proof and non-durable goods as opposed to durable goods, right? And so I knew now all of a sudden I have a very strong local economy because the employers who are giving people jobs there, they are recession proof products. And then the industries as a whole, aside from non-durable goods, it's mostly healthcare and government jobs. So really strong local economy, a lot of economic reasons to be excited to be there. Not a lot of supply coming online, not enough rental units to service the people there. Really good place to invest. So I'm kind of telling you a lot, right? But I think the two examples can give a really good sense for like, it takes a lot of work to figure out where is best to invest, but
Well, I think
that's kind of the
it's
process.
all of it, right? I mean, and that's what it sounds like. Your research for and looking for what's the next place that's going to be developed. I mean, the real estate investors say when all the skyline's full of cranes, it's time to run.
Yeah.
Because everybody's building and
Right.
and it's going to be oversaturated.
Yep.
Within once everything's built. So, and it's funny. I was just thinking when you were talking about, I've read some stuff with Warren Buffett and how he would just research a company for like years, and then he would pick the winners because he knew exactly about all of those nuances that made the company end up going to be stronger than anybody realized. Sounds like you're doing the same thing.
Exactly.
It's just you're really looking for all the factors in that area and finding it before anybody else.
Yeah, I'm looking at fundamentals.
Right.
Like Warren Buffett would say, just good old fashioned fundamentals.
Yeah.
Don't make it sexy. And we could swing for the fence and go invest in Texas. And if you structure your deal the right way, you can really win big there.
Right.
But I think about Babe Ruth, who swung for the fence every time. You strike out hard eventually,
Yeah.
right?
Yeah.
We prefer to hit doubles and triples and maybe the occasional home run.
Yeah.
And we're all the better for it as opposed to swinging for the fences.
Yeah.
And so that's just our model, and our investors are better off for it.
Yeah, so you're doing that. You're doing a ton of research. Then you figure out the area. Say, okay, hey, the industry's strong here. The cost of living's low. I think, and then you kind of the next step is to get there and start looking for.
And then
buildings.
Then you start forming those relationships with the brokers, and you start looking at the deals. And in a lot of ways, it really is like any other real estate deal. How much money is coming in the door, right, in form of rents or pet fees or different types of fees? But what's all the income it's generating? and what are all the expenses that it's incurring, and then you kind of look at it over a period of time. Can I raise rents? Do I have to renovate the units? Like, what's really the value add play here? And what do we think we're going to generate from that? And we have models that help us, figure all that stuff out. But that's really, the crux of it. That's the science behind it. It is a lot of work, but if I'm going to simplify, that's really all it comes down to.
Yep.
And you got to go through a lot of deals before you get the right one.
So that brings together, you kind of crunch your numbers, you kind of put together your deck, and then you say, okay, this is going to be a good deal, and then you go to get some money.
Well, typically, yeah. So when we know it's going to be a good deal, we'll submit a letter of intent, which is really just the first step to an offer. It's kind of an unnecessary step, but you go through the whole offer process. When we get accepted, sometimes you get a chance to walk the units beforehand, but maybe they only limit you to a few. We don't really reach out to investors yet because we want to walk the units and actually perform some due diligence and do an inspection, and then go back to our models and say, okay, they didn't tell us about that. That's going to cost us another 40 grand to update, right? Like, we tighten up, button up our models, and then we say, is this a story that investors are going to get behind? Once we feel good about our final offer price, we say, yep, okay, here's our final offer price. That's when I'll go to investors. I'll build a pitch deck, a nice presentation, photos, all the models included, and I'll start walking them through it. I'll hold a webinar or whatever, and investors will raise their hand and say, count me in for 50,000 or 25 or 100, whatever it might be. And usually, for a 50-unit deal in the Midwest, the dollar goes farther. So you're not spending $30 million on 50 units there. You might raise somewhere between $1.5 million and $2 million, and the total purchase is probably $4 million bucks.
Okay.
So it's still small change compared to some of the deals that are being done out there.
Yeah. What have you, doing your due diligence, any good stories of you having to walk away, kind of figuring some stuff out? Yeah.
So last year we closed about 200 units. That includes one deal that we helped another team close, but we would have hit we had a target of 500. We would have hit that. I mean, at one point we had 262 units in Columbus, Ohio. We got on site, started to inspect, and there were a few foundation issues and structural issues really that threw our CapEx budget through the roof. And so you get to a point where either you find something structurally and you have to go back and renegotiate. And it's been a tough market because even though interest rates are going up, sellers haven't really softened their expectations. They're like, no, this is what I can get.
Yeah. And
so you had to walk away. And that's unfortunate because you pay for your team to fly out there. An inspection on even a 50-unit property, it could be 10 grand, right? You're not talking about $600. And so you do forfeit some money, but that's our money. It's never investors' money.
Right.
This story for a lot of operators, I refer to ourselves as operators, even though we're real estate investors, just to so people understand. The investors are the people that give the money. The operators are the ones that structure it and manage it all. But operators, I go to conferences and we all talk about all the deals we had to walk away from because a commercial deal can take 3 or 4 months to close. So you can't get it all done in 30 days. And, during that period, interest rates might have gone up 2 or 3 times. And now the model's completely flipped around, right? And so you've got no choice but to go back and renegotiate because if you close at your original price, you're going to lose money from day one. And so again, sellers were not willing to budge. So I had to walk away from a lot of deals. But, I always say buy slow, buy right, everybody wins. So it's just a part of the process.
Yeah. So I could imagine like last year or the last year and a half with all the rate hikes, like it just
killed a lot of deals. And it's crazy too, because, I think, nobody really knew where anything was going, but the writing on the wall at the time was pretty clear. Rates are going to go up a little bit more. So for the sellers, you'd think that they would say, if I deny this guy walks away, we start all over again. The next offer is going to be that much lower. But a lot of sellers just didn't want to budge.
Yeah. It's interesting. So now are you doing, maybe correct me if I'm wrong, or I heard you wrong. Are you continuing to manage or put management companies in place?
Yeah.
Yeah.
Both.
Okay.
So we put very qualified management companies in place, and we have a whole due diligence process just around that. But then we've got to manage the property manager. So kind of like, I'm the CEO of the company, and they're really just an extended part of our management team. On a weekly basis, I expect certain reports from them. They get on the phone with me, we review them. On a quarterly basis, I'm on a plane. I'm out there, I'm walking. I'm verifying what I'm seeing through video and pictures.
Yep.
You know, so we are still very close to it. So you're managing the property manager, but they're the ones on the ground doing the lease ups, dealing with the day-to-day headaches, the routine maintenance, coordinating construction, and we're just overseeing all that from a distance.
And that's, I mean, but that's still a whole other aspect of it too.
It is.
You know, continuing the operations of the buildings.
That's really where deals are made or lost right there. Yep.
Yeah, because a bad management company can, all of a sudden there's no money at the end of the year.
That's right. Yeah,
You know, 'cause
exactly.
They can't keep the vacancies are high, and they've got it's interesting. Where do you see? I mean, I know residential is strong, and we're in such a housing crisis, but I know, and you're not really in commercial, so that's kind of safe, because commercial, I think right now, is commercial real estate in general, like retail. I mean, who knows where this is going?
Yeah.
Yeah. What are your thoughts on the commercial side? Like, it's just
Yeah. Well, office, I wouldn't touch it with a 10-foot pole
Yeah.
unless you were going to do an adaptive reuse project, which for folks who might be watching this, is you're just basically converting an office space into something else. But multifamily has historically been strong. It's projected to continue to be very strong. The opportunity in multifamily is actually the greatest it's ever been in American history. But office, God help anybody who decides to play ball there. General brick and mortar retail, you've got to be really careful there, obviously. Industrials and multifamily, so like warehousing space and multifamily is really where I'd be looking to put my dollar if I was anybody else right now.
Yeah. Have you thought about, because again, I mean, you're moving now to different states to be able to find the good deals, but I'm understanding you why you're going to different states, because you're looking for, you're trying to catch the bottom of the, where it's about to go somewhere.
Yeah.
But
and there's favorable politics there
right,
too. I mean,
all of it.
Yep,
right,
yep.
gotcha. But I look at, we have to do something about, we're in such a deficit even in Connecticut here with housing. I mean, it's the federal government, the state, all the local towns are talking about low income housing. What do we do?
Right.
I know the state pushed down 2 years ago or 3 years ago that every town had to come up with a plan. I've actually thought about starting a consulting agency to help each town, figure out what's the local buildings that can be repurposed for low income housing. Been kind of doing that, but there's a problem. Like, as a builder,
Yeah, there really is.
we've been building at a deficit for like the last 15 years. Like, we haven't even kept up. So each year you're behind the 8 ball for bringing housing units to the market. And then you look at it, like here in Connecticut, there's just not enough land for big developers to come in and just put up, it's not like the Texas or Georgia where they put up thousands of properties at once. Have you thought about going into that space of trying to repurpose, or looking at,
Yeah, well, it's easy to think about because the opportunity is so large. There's a lot of money to be made there for anybody who can form the right relationships with the local municipalities to get all that stuff done. But, I think we've been really successful because we've stayed in our lane.
Yeah.
And I think we're, for the time being, we're going to continue to do so. It's attractive. It certainly is. And I do think about it, but I don't think we're going to tackle that anytime soon. From an affordable housing standpoint, though, there's a real opportunity there. It's close enough of a parallel where we're not really stepping out of bounds. So, give you an example. I'm waiting for Connecticut to get a little bit wiser about this, but Massachusetts has really kind of figured it out better. Give you an example. Or I'll tell you a quick aside. So I rent a lot here locally. My personal portfolio in Connecticut, I do a lot of Section 8 because I like working with them. You can get top of the market rents. I do very well. It's very profitable for me. I'm always saying to the agencies, though, you got some bad 8 balls who like really do some serious damage to your property. And they're always worried about losing landlords for that reason. They can't get enough of them. And I say, when is the agencies going to start taking accountability for some of these people and, pay me back for the damage that they do, right? Or double the security deposits. Because out west in Indiana, for example, we take on Section 8 tenants. We had one woman, and her story is unfortunate. She just lost custody of her kid to her parent, but she was using drugs. And anyway, she went home and decided to take a hammer to the walls and take her frustration out on our unit. Section 8 said, don't worry about it. They had it fixed within a week. The unit was turned all at their cost. Now here in Connecticut, that's coming out of my pocket.
Yep.
Massachusetts is doing something similar where they have agencies that will master lease some of these units from you, and they will foot the bill on those repairs. That makes it really attractive for me to come in and say, okay, I'm going to lower my rents, make them affordable, form these partnerships with these agencies to do that. That allows me to boost my net operating income, and then I can generate a nice profit. Or on the flip side, you can form a relationship with the town. You can get them to basically wipe out 5 years of your taxes because you're keeping your rents affordable. So there are different things that you can do in the affordable space that I think are a quick win for a lot of landlords who are willing to try it out.
And I think you're right. There's a lot of landlords that are frustrated with the state of Connecticut and the laws.
Yeah.
I mean, there's not a lot of, we don't really have anything to stand. It's the tenants are always win in every way. So I agree. It has to be both. It has to be, to fix anything so complex as housing. And I've had a lot of people on the podcast. We've talked about this from different angles. It has to be, everybody has to chip in on it from a different, in their lane to try to fix this. Because some of the things is, I was talking to this the other day, was the baby boomers won't get out of their homes because it doesn't make sense. They don't want to go. So they're sitting, when you look at units per people, like they're in these 3,000, 4,000 square foot housing, but they're empty nesters.
Yeah.
They've got 5 extra bedrooms, but they doesn't make sense with interest rates for them to move somewhere, pay capital gains on their this big estate.
Right.
So they stay in that house when really that house needs to be sold to a family that then can bring in, So we have this perfect storm of not having the units to the builders aren't building it, interest rates being high, all these baby boomers keeping their houses, and then the towns, they just one other thing that just came across with this, they just rolled out this ADU, accessory dwelling, so it frees up the zoning in these towns, because a lot of these towns won't allow any kind of housing. These smaller towns are just like, nope, you can't put more than 2 units. So there has to be a change across everything to, so these auxiliary dwellings are just rolled out, and a third of the towns in Connecticut just took on the legislation from the state and said, okay, we're in for it.
Yeah.
The other 2/3 are like, okay, we're going to look at this and then we'll adjust it based off of what we want to do. But basically what that is, it's allowing people to put, accessory dwelling on their home. So you can put an apartment, so you can put like a small 1,000 square foot house on most of, on your land, which can solve some of these issues with, people that are aging, that, you can, if you have your parents, you can put them in the house in the back. Right. So that's something, but there has to be a lot more.
Yeah. And even if, the towns would allow it, you look at the cost, there's just, there's not a lot of upside for builders right now, I think. Right. And so, when they roll out credits for people to buy new homes at higher prices, you're just facilitating even more inflation, when really they should be thinking about credits for builders, wipe out taxes for builders, et cetera, to create more supply. And I think the politicians are just approaching it backwards.
I mean, with inflation, and a couple of years ago, plywood's $80. I mean, I know some of the builders in the state, they just had to shut down because they're like, listen, I'm in contract, I can't build this house. It's costing me $40,000 more per unit just for the thing. I mean, we lost our shirt. Same thing. We had all this work in contract, and then everything's spiking, and you try to get your money back in change orders, but sometimes you can't. It's interesting. It's definitely interesting. I think people want to get on social media and, spout off about a lot of different stuff, but they don't realize this stuff's pretty complex.
It is.
There's a lot to it, and everybody's trying to figure it out. But there's got to be a breaking point, because you look at some of the demographics that just are staying at home. They're just like, I'm living at home with my parents because I got nowhere to go. Yep. So it sounds like typically those, those units, what class are they? Are they A, B, or C?
Good question. So
Mm-hmm.
we typically will do C or
Mm-hmm.
B class units. We don't really go for A, just because there's more value add potential. We can generate much higher returns on the C
Yep.
class units. I
Yep.
think people, they want these big, sexy, glamorous A class apartments, but the returns are a lot lower.
Mm-hmm.
It might be to some degree a little bit more of a safer investment. But there again, I think that's what a lot of investors thought going into Texas. Like, wow, look at that gorgeous apartment complex. Looks like a resort. I'm going to put my money into that. Meanwhile, this new supply comes in, right? And this
Mm-hmm.
beautiful resort, what you thought was a great investment, you've now lost. You not only are not getting anything, you've lost your $100,000. So
Right.
um, you see a lot less of that with C class. So we
Mm-hmm.
like C and B class. There's a lot of room to add value. This year, we're going to probably be moving up a little bit more, B plus, some A minus out in Seattle to hedge our portfolio a little bit, give investors an opportunity to invest in both.
Mm-hmm. Yeah, gotcha. I mean, is there really out is it? Do you have to look for different management companies, or do management companies
Yeah.
typically, do they stay in their lanes, or they usually take care of any class?
They usually will take care of any class.
Mm-hmm.
They usually have pretty good experience if they're in the industry. We usually do look for new partners. Like when we take over an asset, we
Mm-hmm.
usually fire whoever's there. I mean,
Right.
we're buying it probably because it's underperforming.
Mm-hmm.
But we do have a really strong regional partner in the Midwest. They manage 5,000 doors across the area, have a long history, proven history.
Mm-hmm.
And we didn't just find them and sign them up. We spent a lot of time working with them
Yeah.
first. So we get really qualified partners. But ultimately, the real vision for us is, as we scale our portfolio larger, we're going to bring property management in-house, hire our own teams.
Mm-hmm.
We can control the cost and the quality better. There's ways that we can do that, right? We can build organically on our own by just poaching talent. We
Mm-hmm.
thought about, let's go find an institutional quality property management partner who wants to be in more of a startup. Again, poach them, right? Bring them in, they get standed up.
Mm-hmm.
So we're not, this isn't Kris trying to establish a successful property management company. I can do it, but it wouldn't make sense. Or,
Right.
We're in talks with this regional company that we like. We can buy a 51% stake in the company or all of it and just take over from there. So, I mean, the classic buy versus build. But eventually the vision is to bring it all in-house so that we can manage our portfolio centrally.
That's interesting. And it makes a lot of sense. You go in and you fire the property management company because there's a reason why they're not performing. I think that's in general in life. Like people, you just kind of get set in your ways, or you think this is the way you do it. And if there's a lot of businesses out there that are owned by the baby boomer generation that are
Yep.
just they got one foot in there on their second or third home, and they're just like, it's spitting money out,
Yeah.
whatever it is, we're not going to change it. Plus, I think technology has moved so quickly that it's tough to keep up. And if you're not kind of reinventing yourself, there's so much more effective tools out there to implement in your business, that can make you way better at, and if you're stuck with, still with the paper,
Yeah.
and the stamps and stuff like that.
It's
Like,
a really good point. We use that term, reinvent yourself. And I think you have to. If you don't disrupt yourself, somebody
Mhm.
else will. But I think even in the multifamily space, and even in the case of some small businesses, that they kind of have a if it ain't broke, don't fix it approach,
Yeah.
and until it's too late. Or I think for a lot of people who buy multifamily, they don't think of it like a business. They don't run it like a CEO should. They
Mhm.
just want to rent it and forget about it. But
Right.
that's what creates the opportunity for us eventually.
Yeah.
Yeah.
Yeah, it's been interesting. This AI is it's fascinating. I don't know if you've kind of,
Oh yeah.
well, I know you've been, that's that type of person you are. But it's, it's game changing for everything.
Yeah.
And I would imagine you probably could even use it to analyze stuff. But have you been kind of thinking about how you can implement that in this?
Yeah, so we certainly have been trying to think of some real use cases for where that could be of value. We it's more of a goal for us in the second half of this year to work with some vendors to see if there's an application that makes sense for us.
Mm-hmm.
But we do have a team in place that know our process, and we trust them. And you hear the stories about the models, the artificial intelligence models sort of getting some things wrong. So I don't
Yeah.
know that we're ready to put the
Yeah.
marbles in those baskets yet, but it's on the agenda to
Mhm.
look into it this year, but we're kind of wait and see mode right now. Look for some real social proof of it working out there in the
Right.
marketplace.
Right.
Yeah.
Yeah, it is funny because there is definitely some, some people that have gotten in trouble by,
Yeah.
yeah, saying whatever I think a couple attorneys did.
Yeah. I was gonna say, did you
Yeah.
hear about the
Yeah,
attorney?
yeah.
Yeah.
But I was talking to a potential partner to help out in the development of. He does assisted living, and he does more of the remodeling. Goes in and tries to do 30 or 40 units and put that in place, and then he runs the homes from there. And he's excited. He actually brought me in because he had a presentation on AI, and because he's just like, I'm gonna put this in every room so that the patients can talk to the AI, ask
Yeah.
questions, and then he doesn't need as big of a staff because you know you can create these models that are just looking at all the data even internally of the company, so reading all of the manuals, and then
Right.
somebody can just go and say, hey, this patient so and so, this is happening, what should I do? Or the A is just monitoring the situation and then it's just spitting out,
Yeah.
hey, based off of all of your all the your manuals and all that stuff, this is what you should do.
Yep.
And so he's just like, I'm gonna need half the staff. I'm gonna, always have the right answer. So he's an older guy. He's just excited about it. I'm like, listen, I'll be excited too. I mean,
Yeah.
it sounds cool. Um, but who knows? You are right. It's still new. It's still not. We use it a lot in marketing right now.
Yeah.
Um, but and Liam will do stuff and we'll look at it and be like, hold on, that's not right.
Yeah.
Where are they getting this information? Um, so all interesting stuff. I think um, so what are do you have any big things going that you're planning for this year? Where do you feel where are we going this year? Is it? I feel like the government's got to, if the Democrats have a chance to be reelected, they've got to they got to drop interest rates. They have to make it look good, at
Yeah.
least.
I'm sure they're going to pull their political levers. I think the Fed is doing the right thing.
Mm-hmm.
I certainly didn't anticipate any rate cuts. The last thing, I think what's heavy on their minds is a repeat of the 70s and the 80s, where you had a similar inflationary period. They started to cut rates too fast, and then boom, it surged back, and you're in a much worse position.
Yep.
It's better to be cautious. I think you'll see a rate cut or two this year at some point.
Mm-hmm.
But I think slow and steady is better in this case. But there's still lots of opportunity in real estate. You're going to see a lot of deals hit the headlines, go belly up. There's a lot of people who thought that magical run was going to continue forever, and they structured their deals as such. And unfortunately, a lot of investors, a lot of hardworking people who are trying to, put their retirement bets on the line are going to lose it all. But I think going forward, you just be smart about how you structure your real estate deals. I know it's not the question you asked, but I think for real estate, tremendous opportunity when the deals are structured properly. You can really capitalize on any market cycle. But I think it's going to be a good year. I think if I were to try to project anything, I think we will have the closest thing to a soft landing. But the cracks are forming, and if history has taught us anything, we have what looks like a soft landing, and a year or two later we get the real recession, because it takes time for those cracks to really manifest any real impacts. But we structure our deals with that in mind, and so we make sure we go into everything with long-term debt, so we have multiple exit points, so we're not forced to sell at a less opportune time. So for us, we're not so overly focused on that so much as the questions we're asking ourselves. If and when these things happen, are we structured in a way where we can withstand that? And unfortunately, like I said, a lot of other people were just rolling the dice or betting everything on red. Things were going to turn out better than they did, and that's just not the way to grow a business.
Yeah, I think it's interesting. I'm not, and I don't follow this as to really know too much about it, but office and retail, I think there's no hope for them. I just there has to be a pretty good hard hit for it to, and then figure out what are we going to do with all these buildings. I don't think I think there's companies are coming to the point where you see in the news, employees are just refusing to go back to the office, and I think they're realizing, well, we need to learn how to manage differently, and and it might not make sense to bring people back. And I think once that decision is made, I think I see a lot of companies just getting rid of the office space, and then all these,
Well, small businesses in particular employ, I think, what, like 49%. So it's almost roughly, half and half in terms of the labor force. And all these studies are showing that they're actually just getting rid of the office altogether.
Right.
And it makes a lot of sense. You don't have the balance sheet to withstand the overhead, and rent prices are going up across the board. So why not just work with a virtual staff? But I think big corporations are trying to strike a balance. But either way, you've got a massive problem in the office space that's not going to go away.
Yeah. And then retail has kind of been the same thing for a while with
ever since Amazon, really.
Yeah.
I mean,
and there's been, and you don't realize because I haven't gone out to the mall or shopping or anything, but it's just desolate. And there's big companies that are holding on, but they're just riding it out, and they're probably sitting there, breaking it apart and getting every last dollar out of it before they do go for their chapter.
Yeah, exactly.
I think what Best Buy is like, all of them. It's just why would you go to a store?
Yeah.
And there's Amazon. It's crazy. But I guess, I look at all that stuff as an opportunity. What do we do with it all?
Right.
It's and it's weird though, because somebody just bought the Waterbury Mall, I think, or it's in talks. Saw something. I'm like, what? There's one store in the whole place that's still, huh? Oh, they pulled it off.
Did they?
Yeah.
Same thing with Enfield Mall. I mean, that thing has been vacant for years now, and they had a developer come in,
right,
put some great proposals, 3 options on the table. The town voted against all 3 of them.
right.
You've got a bunch of older boomers who don't like change. They don't want to see any new real development, but they really shot themselves in the foot without even knowing it.
That is, and that's Connecticut. That's New England for you too.
Yeah.
We're very like entrenched and tough to like change, in every way. But you're right. It's I was talking going back to the low income housing. You get in some of these rural towns, and their residents are just, they've already got the attorneys on retainer.
You can incite a riot if you say affordable housing.
Yeah, and they'll just all lawyer up and sue everything. We'll keep it in courts till we die.
Yep. It's unfortunate. Yeah, it's the truth.
Yeah. All interesting stuff. And in housing, it's so important. I mean, it's just, and I'd imagine, it's good that you're doing this, and you're going in and getting buildings back up more efficient, being able to, and it's probably fun. I would imagine, you go check out the building, and you've kind of got it back up. Nice and clean, it's fully
a cool feeling.
And, and you're providing housing. So I don't know. We'll see. I agree with you for with any change, there's going to be disruption to different segments of the market. I'm an optimistic though. I don't think it's the end of the world. I think, even if we were to correct ourselves with a good recession, you kind of need to. Yeah. You need to reset things.
Yeah, I mean, restore the balance. Yeah.
Yeah. I mean, because you had a lot of people doing dumb stuff, and now
Yeah.
you're putting deals together, and what I'm getting out of this is how disciplined you are, and how like really you get in and make sure everything is you're doing your research, and that the guys that aren't doing that and they're throwing it in, the minute the interest rates tick a little bit, the deal falls apart, because it's they didn't have enough meat on the bone.
Yeah, exactly.
And I get it. I think we all find ourselves doing that, where we're like, yeah, well, it'll work out. It doesn't work out. So anything else you want to kind of talk about for the commercial or
Well, I think, just private equity in general. I think a
Mhm.
lot of people hear about it. They don't really understand the true power of it. I mean, I would really would encourage more people to look into it.
Mhm.
I think there's this misconception that you have to be ultra wealthy to get involved. That's not true. You just need access. You need to know folks like myself. So I would encourage anyone listening who's interested to reach out to learn more about the space,
Yep.
the benefits that it can provide, how you might use that to augment, your own personal investment strategies with your 401k, et cetera. The last thing you want to do is be all overexposed, all in on the stock market, right?
Mhm.
Imagine being somebody in the Great Recession. You're on the cusp of retirement, and you've been forced back into the labor force for another decade because your retirement savings got cut in half. And private
Mhm.
equity is really not really susceptible to those types of volatile market turns, and it can generate literally twice to 3 times the returns you would in the stock market. So it's extremely powerful. I would encourage folks to look into it. Reach out to me. Certainly happy
Yeah.
to help them on that
Yeah.
journey. And again, you don't need gobs of money to get in. You can get started in some cases with $25,000 investment. It doesn't even have to be cash. I think a lot of folks don't understand that you can actually use your 401k funds
Right.
to get involved in these types of investments. So there's this whole other world out there that I think people should really take an effort to learn more about, because it can radically change where you end up in terms of your retirement savings and how quickly you
Mhm.
can get there. So that's what I would offer up.
So with the 401k, would that be kind of like a self-directed?
That's exactly right.
Yeah.
Yep.
Okay.
Self-directed IRA. And we do a lot of those. We have a
Right.
lot of people who
Mhm.
invest
Your
self-directed
financial
IRAs.
advisor doesn't want to know that. Here for
No,
that.
your financial advisor does not want to hear that because they
Yeah.
don't get paid.
Yeah.
And most of them don't even know anything about
Right.
syndication.
Yeah.
They just don't understand it.
Yeah. I learned all, I don't know if you know Mark Kohler. He's out in Indiana, I think. He's check him out on YouTube.
Yeah.
He really pushes all that stuff. He's got a great podcast. He's written a bunch of books, but he talks about that. But to follow that up is, when you invest in the stock market, and this is not any advice at all. It's you don't exactly. It could be companies. They could go, but real estate is kind of, it's an actual place somewhere.
Yeah.
And it's a housing where
Yeah.
we're in a crisis. The housing, we need housing. That's not gonna miraculously go poof.
Right.
It's that's what has kept me, able to sleep at night, is just knowing, our rentals are there, and everybody is always going to need an apartment to live.
That's right.
And it's not, it's an age old good investment, and it's not some new age widget that everybody's betting on that's Bitcoin's going to.
Right. Yep.
It's interesting. So how does that work? So hey, so somebody's like, hey Kris, I got 50 or 25,000. What would they reach out to you?
Yeah. So according to the SEC laws, right, this is all governed by the SEC,
Yeah.
and that should give them comfort. Like this is closely monitored by the government, because it is essentially, we're selling securities. They reach out and say they're interested. We have to form what's called a substantive relationship first. So I have to, they have to get to know me, the company, understand the true benefits and risks. And then really it comes down to getting on our investment list. And when we have an offering, when we have a deal that we're going to offer out to folks, we will reach out to them and say, hey, here's the deal. Here's everything you need to know about it. And if you want in, it's really as simple as signing what's called a PPM, a private placement memorandum. It's basically just outlines all the risks and the benefits of the deal and everything that we've talked about. And then a subscription agreement, which is basically saying, Kris Morin, I'm buying one share in this for 25 grand or 50 grand. And that is securing my place in that deal as an investor. And in doing so, I'm actually buying a slice of that deal. I actually own a piece of that deal. But as a limited partner, the investor has no liability. They don't ever have to do anything other than just sit back and collect the rents or collect the distributions that we give to them from collecting that income.
Right.
So it's sign the PPM, sign the subscription agreement, and you are officially locked in. It's really a very easy process. We hold their hand through the entire thing. It's all managed electronically on a secure portal. They sign all the documents electronically. And it's all closely governed again by the SEC. So we've You
That,
know, we
that
check every box.
that's awesome. And what kind of what kind of return does that? Can you kind of feel that
Yeah.
it gives?
So great question. The deals that we do, we typically return between 16 and 18% average annual returns.
Mhm.
If we get a really good deal, things go better than planned. Sometimes it's 20 or above.
Right.
We always model out worst case scenario, and we purchase and manage so that we already know what are the worst possible scenarios that could surface, the factors that could disrupt us in some way, loss of income, whatever, increased expenses. And we know going in that if that worst case scenario pans out, we always underwrite it to purchase so that if we hit that, it's still about a 14% average annual return. So our investors can expect worst case scenario, 14% all the way up through 20. And we typically land in the 16 to 18 range.
Gotcha. That's pretty crazy because
Yeah.
you're not gonna, your mutual funds aren't gonna do that.
No, no.
Yeah. And is that similar? Is that similar? What like people might know is like Grant Cardone is doing. Does a similar thing? How he
I mean, it's pretty
raises?
much the same thing.
Yeah.
He's crowdfunding, he's sourcing funding.
Yeah.
I mean, really, at the end of the day, he's doing the same thing. But he's buying different deals, different risk profile. Those returns are actually a little bit lower,
Right.
because you're paying an extreme premium for really nice properties. But the thought there is, and it's a little bit of a flawed logic at times, depending on the market cycle. But the thought there is, it's a more sturdy product. It's more dependable. It's more predictable because it's newer.
Mm-hmm.
You're not going to have emergencies. But because you're paying a premium, you're getting less of a return on it. So the investors feel safer.
Right.
Doesn't always work out that way, right?
Yeah.
But that's kind of the essence of how they're different.
Yeah. I didn't know if I should have brought his name up or if it was, because it's polarizing sometimes.
Yeah, he's competition.
Yeah. Gotcha.
Yeah.
Gotcha. But it's something, a lot of times I think when you're in and you're doing something that a lot of people don't know of, it, half the time you're educating.
Right.
And if you do have, competitors help educate the client.
Yeah.
So in some ways, the competitors can be good. I mean, we like to go up against other similar companies just because that other company will educate the client also.
Right.
And then also price anchor them because there's carpenters out there that are
Right.
charging $5 and
Yeah.
that's what
Yeah.
clients think. So, well, Kris, I'm glad we finally met. I've been, I think we see each other on social. You're definitely inspiring out there, making it happen. And I think if anybody's, interested in, they have some extra cash, and I think if they understand real estate, they know it's a good deal.
Right.
And just kind of what we heard from you, how disciplined and dedicated, and really, I mean, you're really going about it in the right way. You're catching it before all those cranes are in the skyline.
Yeah, exactly.
So then you've already established, and you're gonna ride it up.
That's right.
So I obviously you're gonna continue to have a lot of success. So I appreciate you coming out. I mean, I feel honored that you're you're making it happen out there. So
Yeah,
I appreciate you
likewise.
coming on, and we'll put some links to you in the all of the when we post. So hopefully you can get some people to invest with you.
That'd be great. Thank you.
Awesome.